Hi, Chase Craig here with CBH Homes, and today I want to talk to you about how you could save money by writing off your mortgage interest. So a lot of people, when they're thinking about buying homes, it's one of the last savings we actually really truly calculate and think out. But it's a big one, so I want to make sure you're aware of it before you purchase. So we're using in this example an $800 monthly payment. So by the time I've taken out the taxes and insurance, we end up with principal and interest. We average the interest, we figured you paid about 90% towards interest and about 10% towards principal when your mortgage is first starting out. That equates to about $640 per month that you'd be paying in interest, which is better than renting where, as you know, you pay everything towards the landlord. Nothing goes towards principal because there is no principal. You don't end up owning anything. So we've taken that $640 per month that you're paying and calculated over a year. That's $7,680 per year that you're going to be paying in mortgage interest. Now I know you're thinking, oh my gosh, that's crazy. Well, on an $800 a month payment, you're going to be paying $9,600 per year in rent, and you're not going to be able to put nails in the wall or mow your own yard without asking. So just keep that in mind. All right, on this next page here, we kind of go over an average household income of $40,000 per year. If we had roughly a 20% tax deduction, excuse me, if we were in a 20% tax bracket, that's kind of what I'm basing these numbers off of. So you might be in a little bit higher bracket, which is even better. You might be in a little bit lower bracket. It doesn't really matter. This is kind of right in the middle. So what we do is we take that $7,680 that we paid in mortgage interest, and we get to deduct that from our income before we pay taxes, which is phenomenal. It means you're going to either get more money back at tax time, or you're going to be paying less money at tax time. So here's how that works. Instead of paying 20% taxes on 40 grand, which would be $8,000 in taxes, you'd be paying 20% taxes on $32,320 because we get to deduct our mortgage interest off of your income. So now we're paying $32,320. That's what our income is with this example. That's not including any other deductions that you might already have, like daycare or other things to that effect. So instead of paying $8,000 in taxes, we're going to be paying $6,464 in taxes, which is about $1,536 per year that you get back in your pocket that doesn't go to the government, because you own your own home and you're not paying rent. What does that equate to per month? Well, that's about $128 per month. That's the potential. Now, obviously, you do get standardized deductions. If you really want to find out for your particular situation what it is that you would save, I definitely recommend you talk to your accountant. Standardized deductions might be as little as $5,700 or as much as $11,000. However, when you add all those other things up that you're already paying for and you already get to deduct, you get to add this mortgage interest on top of your deductions. So again, see an accountant if you really want to find out what your actual tax bracket is and your actual savings is. But as you can see, you can save up to $130 per month in this example. That's huge.